Maximize your Social Security benefits after the new law. Imagine having to make a decision that could potentially impact your retirement income by tens of thousands of dollars. For many Americans, this is the harsh reality when it comes to deciding when to start taking Social Security benefits. The question of when to claim these benefits is a complex one, and there's no one-size-fits-all answer. But here's the thing. With the recent passage of the One Big Beautiful Bill, the rules of the game have changed. And it's more important than ever to get it right. So what's the best time to start taking Social Security benefits? The truth is, it depends on your individual financial situation. As a financial advisor, I've seen many clients struggle with this decision, and it's not uncommon for them to hope for a simple, straightforward answer. But the reality is that determining the best time to claim Social Security benefits requires a deep dive into your financial situation, taking into account factors such as your income, expenses, assets, and retirement goals. Now that the One Big Beautiful Bill is law, there are even more questions surrounding this topic. The new law introduces an extra deduction of $6,000 for each qualifying individual age 65 and older, which can be a game changer for many retirees. However, this deduction phases out when your modified adjusted gross income, MAGI, exceeds $75,000 for single filers and $150,000 for married couples filing jointly. So how do you navigate this complex landscape? The first step is to take a close look at your financial situation and determine your eligibility for the extra deduction. If you're already receiving Social Security benefits or planning to claim them soon, it's essential to review your income and expenses to ensure you're not at risk of being phased out of the deduction. One strategy to consider is reducing your taxable income by drawing from taxable investment accounts rather than tax-deferred accounts. Another approach is to rethink Roth conversions in the short term to avoid raising your income above the phase-out threshold. However, it's crucial to weigh the short-term benefits against the long-term impact. For example, a couple I worked with recently were both planning to retire and claim their Social Security benefits at their full retirement age of 67 in 2027. However, given their other fixed income sources, their MAGI would exceed the phase-out threshold, putting them at risk of losing the extra deduction. To mitigate this, we explored the option of having the wife claim benefits while the husband delays claiming until a later year when he would receive a higher benefit. This strategy allowed them to withdraw from after-tax investment accounts for supplemental income in the short term while preserving the maximum benefit for the surviving spouse. The Social Security benefit system can be complex. With a sliding scale of benefits starting at age 62 and increasing gradually until you reach your full retirement age, FRA. Your FRA is based on your birth year, and it's essential to understand how this affects your benefits. For instance, if you were born between 1955 and 1959, your FRA is 66 plus 2 months for each year after 1955. If you delay claiming benefits until age 70, your benefits will continue to increase at a premium rate of 8% per year. But here's where it gets controversial. Some experts argue that taking benefits early can be a good strategy, especially if you have health issues or a family history of shorter lifespan. On the other hand, others claim that delaying benefits until age 70 is the best approach, as it maximizes your lifetime benefits. So, what's the right approach for you? The answer depends on your individual circumstances. If you're pushed into early retirement due to health issues, job termination, or caregiving responsibilities, it may make sense to take benefits earlier. However, If you have a family history of longevity and good health, it might be better to delay benefits and let them grow. The key is to take a holistic view of your financial situation and consider all the factors that affect your retirement income. As you approach retirement, it's essential to work with a financial advisor to assess your assets, income sources, and tax situation. By doing so, you can make informed decisions about when to claim Social Security benefits and create a retirement strategy that works best for you. And this is the part most people miss. Timing is everything when it comes to Social Security benefits. A delay in claiming benefits for the higher income earner could make all the difference in whether the benefit claimed by the other spouse is phased out of receiving the extra $6,000 deduction. So, what do you think? Should you take Social Security benefits early or delay them until age 70? Share your thoughts in the comments below. Looking for expert tips to grow and preserve your wealth? Sign up for our free newsletter to stay up to date on the latest retirement strategies and tax planning advice. New $6,000 senior tax deduction. Are you eligible? Imagine having an extra $6,000 in your pocket, courtesy of the U.S. government. This is a reality for seniors thanks to the One Big Beautiful Bill Act, which has introduced a new senior tax deduction. But here's where it's interesting. This deduction is on top of the existing extra standard deduction for seniors, and it's available whether you itemize your taxes or not. Starting with the 2025 federal tax returns filed in 2026. Taxpayers 65 and older can claim up to $6,000 in addition to the standard deduction. And this is the part most people miss. Married couples filing jointly can claim a whopping $12,000 total. But as with all good things, there's a catch. The deduction is set to expire in tax year 2028. So, who qualifies for this deduction? To be eligible, you need to turn 65 on or before December 31st, 2025, and file as an individual, head of household, surviving spouse, or a married couple filing jointly. Note that the deduction is not available to married couples filing separately. You can claim the new deduction regardless of whether you itemize your return or claim the standard deduction. However, there is an income cap. For individuals, the deduction is gradually reduced if your modified adjusted gross income, MAGI, is above $75,000, and it's completely phased out at $175,000. For couples filing jointly, the deduction starts to be reduced at $150,000 and is completely phased out at $250,000. The most an individual filer can deduct is $6,000, and joint filers can deduct up to $12,000. Now, you might be wondering how this new deduction works. Let's break it down. The new deduction can be stacked on top of the existing exemption for seniors and the visually impaired, which is $2,000 for individual filers and $3,200 for joint filers. Both are distinct from the standard deduction that all taxpayers can claim if they don't itemize their returns. For an example, a 72-year-old single filer with $70,000 in income in 2025 can claim a standard deduction of $15,750, plus the existing $2,000 extra standard deduction and the new $6,000 senior deduction, totaling $23,750 in deductions. This is a significant reduction in taxable income, and it's essential to understand how to take advantage of it. But here's the controversy. Some argue that this deduction is unfair to younger taxpayers who are struggling to make ends meet. Others argue that it's a well-deserved break for seniors who have contributed to the tax system their whole lives. What do you think? Should this deduction be extended beyond 2028? Or is it a temporary solution to help seniors during a specific time period? Share your thoughts in the comments below. And if you're looking for more information on how to prepare your taxes, check out our resources on tax preparation and planning. Remember, it's essential to stay informed and take advantage of the deductions available to you. Subscribe to our newsletter to stay up to date on the latest tax news and tips. At our core, we're committed to providing high-quality service journalism and comprehensive consumer advice to help you make informed decisions with your money. So stay tuned for more updates and let's keep the conversation going.